Hello, and welcome to Organize, the Business Law Breakdown. I'm Professor Seth C. Orenberg, and today we'll conclude our exploration of general partnerships with a brief introduction to partnership taxation. One of the most distinctive features of partnerships compared to other business entities is their tax treatment as pass-through entities, which is a kind of mishmash of the aggregate theory and the entity theory we talked about in previous episodes. Partnerships are not taxed as separate entities. Instead, partnerships are taxed as pass-through entities, which means that the individual partners receive the tax implications of the partnership. In fact, other types of entities can choose this kind of partnership taxation or pass-through taxation. So understanding how it works in partnerships will help you make the selection in general. And in this lecture, we'll discuss the mechanics of partnership taxation and related concepts like phantom income and the importance of planning for tax liabilities in partnership agreements because of this pass-through taxation status. Under U.S. tax law, partnerships are treated as pass-through entities. This means that the partnership itself does not pay federal income tax. Instead, the profits and losses of the partnerships are allocated to the partners, who report their shares of their profits or losses on their individual tax returns and receive a statement K-1. This approach avoids the double taxation that occurs in corporations, which we'll talk about in a future season. Double taxation, in brief, is where the entity pays taxes on its income and then the shareholders pay tax again on any dividends they receive. But under partnerships, there's only one level of tax. For example, if a partnership earns $100,000 in profit and there are two equal partners, each partner is allocated $50,000 of profits. And so each partner must report their $50,000 share as income on their individual tax returns. And this is true regardless of whether or not the partnership actually distributes the profits. And we'll talk about this phantom income later. The allocation of profits and losses in a partnership is typically governed by the partnership agreement. And as usual, if there's no agreement, the Revised Uniform Partnership Act's default rule applies. And the default is that profits and losses are allocated equally among the partners. However, partners can and probably should agree to allocate profits and losses in a way that reflects their contribution or roles in the partnership. It's important to note that allocations must have substantial economic effect under federal tax regulations. Substantial economic effect means that the allocation must correspond to the partner's actual economic arrangements. For example, if a partner provides most of the capital while another contributes only labor, they might agree to allocate their profits and losses disproportionately. And this will be accepted by federal tax authorities as long as the allocation reflects some degree of economic reality. One of the challenges of partnership taxation is the concept of phantom income. And phantom income occurs when a partner is allocated a share of the partnership's profits, but doesn't receive a corresponding amount of cash from any kind of actual distribution. This can create a significant burden for the partner because the partner has to pay taxes on income they didn't actually receive. So how do they pay this cash to the government? Consider a scenario where a partnership reinvests all its profits into expanding its business. Each partner is still liable for their share of profits for tax purposes, even though they might not receive a distribution that covers the tax liability. Partners need to plan for this possibility, either by setting aside funds for taxes or negotiating distribution provisions in the partnership agreement. As a default rule, there's no requirement for the partnership to make distributions so that partners can cover their individual tax burdens. A partner's tax basis in the partnership is a critical concept that affects how distributions and gains are taxed. While tax basis is a concept for a separate session on tax, basis generally represents an investment in something. And in this case, it's the amount the partner invested in the partnership. Basis is adjusted, typically annually, to account for things like profits and losses or additional investments made into the business. For example, if a partner contributes $50,000 to a partnership and is allocated $10,000 on their profits, their basis is now $60,000. Conversely, if a partner is allocated a $10,000 loss, their basis decreases to $40,000. Distributions will also affect a partner's basis. Basis is a complicated tax and accounting concept. The general idea is that the basis represents the amount of value that a partner has in the business. And so it rises and falls depending on things like amount invested and distributions, as well as profits and losses allocated. Unlike shareholders in a corporation, partners are generally subject to self-employment taxes on their share of the partnership's income. This includes both the employer and employee portions of the Social Security and Medicare taxes. For active partners, this can significantly increase their tax burden when compared to passive investors and other business entities. Partners should factor self-employment taxes into their financial planning, and they have to consider strategies that mitigate this impact. For example, some partnerships structure their agreements to allocate a portion of income as guaranteed payments for services rendered, and that simplifies tax reporting and planning. Effective tax planning is essential for partnerships to avoid disputes and ensure compliance with federal regulations. So a well-drafted partnership agreement has to address some tax elements in addition to all the other legal and business elements we've discussed. First, the partnership agreement should have a profit and loss allocation. The partnership agreement should define how profits and losses are divided among partners in a way that reflects their economic contributions. Second, the partnership agreement has to discuss distributions. Remember that phantom income is a problem from some partners, so including provisions regarding distributions to cover partners' tax liabilities can really help with tax planning. This is especially true in cases where the business intends to reinvest profits. Third, the partnership agreement should deal with guaranteed payments. Remember that partners are going to be liable for self-employment income for services rendered to the partnership. So the partnership agreement should specify whether partners receive payment in cash for services or use of capital. This can provide predictable income, and it simplifies tax reporting. And fourth, partnership taxation agreement should include exit strategies, meaning the partnership agreement should address the tax implications of partner buyouts or changes in ownership to avoid unintended tax consequences. By addressing these issues proactively, partnerships can minimize tax-related disputes and protect the financial interests of their partners. As you can see, partnership taxation requires an understanding of tax law in general, as well as some accounting principles. And this means that drafting partnership agreements is not for the faint of heart. Because it's not purely a corporate exercise, understanding partnership taxation is an important part of anyone who engages in partnerships to understand. Partnership taxation can offer advantages. Pass-through treatment can be advantageous for various kinds of entities, and it can be advantageous to get the pass-through losses to offset one's own income. But it also comes with challenges, like phantom income, where you receive an allocated profit but not any cash to pay the tax, and self-employment taxes that you may not have realized and not anticipate. So understanding these issues is crucial for effective partnership management and planning. As you reflect on today's lecture, consider how partnership taxation influences decisions about forming or structuring a partnership. Given the complexity involved in partnership taxation, would this affect whether or not you choose to form a partnership instead of an entity that has corporate taxation? While double taxation may sound terrible in principle, in practice, we can eliminate much of this tax through a variety of means, and we don't have to deal with the expensive and complicated accounting that partnerships require. However, avoiding partnership taxation through pass-through taxation can certainly have its advantages when planned well. Thank you for joining me on this season of Organized, the Business Law Breakdown. I'm Professor Seth C. Orenberg, and I look forward to the next season, where we continue our journey through business law with a new discussion about corporations. Until next time, take care and keep learning.